Hello and welcome to Business Today Television. I am Siddharth Zarabi, and with me today is Mr. Sanjiv Chadha, the Managing Director and Chief Executive Officer of the Bank of Baroda. Welcome to BTTV on a day when the latest numbers that you have declared for the second quarter have beaten most expectations, and the street is saying congratulations today to you and BOB, the entire leadership, Mr. Chadha.
So thank you very much, Siddharth. Thank you for that.
Can you take us through the record profits that you have delivered? What has contributed to this kind of performance? And can you give us some granular details?
Yeah. So I think there are normally four engines which can contribute to the performance of a bank. First is, of course, growth. The second is margins. The third is costs. And the fourth is asset quality. I think we are fortunate that all the four factors have come to bear in this particular quarter. Growth has been very robust. Our loan growth has been of the order of 19%. Within that, retail has grown by about 28%. But as a general proposition, when you grow aggressively, margins do tend to get compressed. But in this quarter, we have seen margins expand also because we have been keeping a tight discipline in terms of deposit costs in particular. The third part is costs. I think a number of banks, again, have had costs also increase in tandem. But for us, the increase in business has not been accompanied by either an increase in manpower or the increase in branches and the physical build. Instead, it has been enabled by digitalization. Bob World, which we launched about a year back, has been an outstanding success. Today, we have nearly 25 million customers on Bob World. So therefore, a lot of growth is coming through digital, where the marginal costs are lower. And last, and of course, the most important is that we have had a benign corporate credit cycle for the past few years. Even when COVID was with us, corporate credit costs were coming down and were outweighing the challenges in MSME and retail. Now that when COVID is behind us, you have both the improvement in the corporate credit cycle as also, again, a far better environment when it comes to MSME and retail loans. So I think all these four factors have come together to make sure that the results are fairly decent in this particular quarter for us.
It's important for us to point out to our viewers at this stage that if we talk about the net profit number for the quarter under review, 3,313 crore, that's up almost 59%. Do you expect this kind of growth to continue in the subsequent two quarters of the current financial year?
So I think this particular quarter was fairly okay for us last year also. So therefore, the fact that we have a 60% growth on top of that, I think that is one reason to, again, be hopeful going ahead. The second part is, I think banks have benefited from the fact that as a general proposition, when interest rates increase, there's a repricing gap between deposits and loans. Loans get repriced faster. So I would believe that that particular benefit would be available to banks for the next few quarters also. Third, again, if you see our growth in corporate, our growth is still relatively muted at about 10%. So there's scope for us to up that. And also, as we go ahead, the MCLR will get repriced as deposit costs also go up. So therefore, again, corporate being about half our loan book, that should benefit from that. So yes, I think I'm fairly sanguine that as we go ahead, we should be able to sustain this kind of trend.
That's a good point, which I want to also extend to your views on how the NPA performance is. I can see from the numbers at a gross level, there's a reduction of almost 280 basis points on an annualized basis and 95 basis points quarter on quarter. Take viewers through that aspect.
Yeah. So I think, as I mentioned, the corporate credit cycle has been in good shape for about 2 years now. It was to some extent obscured by the fact that during COVID, there were challenges in terms of MSME and retail in particular. So that is what has really contributed to a steady improvement when it comes to gross and net NPAs. The second part, of course, is that the credit costs are coming down. That also is something that is likely to sustain because ultimately there are two drivers of credit costs. A, new NPAs, which is reflected in fresh slippages. And two, how well provisioned are you on your existing book? So when it comes to the existing book, if we take our NPAs, we are about 92% provisioned, which means there's very little downside left in terms of the existing NPA book. And if you look at the SMAs, the fact that they have come down so significantly, that would suggest that even in terms of future prognosis, we can be fairly positive that slippages should come down further. So if you add these two factors together, that A, your loan book is well provided, and two, fresh slippages ought to be low, and you have a fairly robust profitability, I would believe that all these ratios have a little more scope for improvement.
Mr. Chadha, if we were to expand on your interest margins, the question I really have, there's a annualized increase of 48 basis points when it comes to NIMs. What is going to drive interest margins in the quarters ahead? And also, if you could speak about the CASA ratio at present.
Yeah. So I think in terms of interest margins, even over the last couple of years, we have tried to keep a very tight discipline in terms of deposit costs in particular, because loan yields were under pressure for quite some time. So I believe that going ahead, we would expect, of course, loan yields to improve as pricing power returns to bank to some extent, with liquidity normalizing. But equally, I think we'll have to be judicious in terms of how we approach the increase in deposit rates, because we cannot for the moment take a couple of things for granted. A, that the increase in loan growth will be on the same trajectory that we saw this particular quarter. And number two, that there is a lot of elasticity in terms of deposit growth, which might be linked to higher rates. So I think if banks are judicious in terms of, again, not being irrational in terms of chasing deposits, then I think we can be on a good wicket. But that's, again, discipline that the industry will have to exercise as a whole. The second part, sorry, go ahead, please.
Siddharth. No, go ahead. Complete your point, sir.
I just want to request you for the second part of the question, which actually I forgot when I answered the first part.
I was just asking for the CASA number.
Yeah. So what happened, I think, is that when liquidity was abundant and term deposit rates were low, the differential between the CASA rate and the term deposit rates was minimal. There was no incentive for people to move saving bank deposits to term deposits. Now that when term deposit rates are rising, you will find again that term deposit growth is going to be faster as compared to CASA growth. If you look at our numbers also, although our CASA growth has been decent at about 10%, but term deposit growth has now moved ahead at about 12%. So I would expect that this trend is likely to gain strength. Term deposit growth will be higher as compared to CASA growth over the next few months. And therefore, CASA ratio will come down.
Yes. And from a consumer point of view, what do you expect to happen on deposit rates? The cycle has clearly tightened, not just in India, in fact, globally.
Absolutely. I think we were in a very unnatural state for the last few years. Real interest rates were negative. That also, again, has an impact in terms of the deposit growth of banks. Now that rates are actually getting corrected, I would expect that rates will move ahead of the inflation rate, which means depositors will get a positive rate of return, which is what they should legitimately expect. And for the banks, in turn, the upside will be that deposit growth rate should be faster as compared to earlier, when depositors would not want to place money with you because you were offering a negative rate relative to inflation.
And what about borrowers? How higher are loan rates set to trend?
So I think in India, we are fortunate that when we reduce rates, the rate reduction was not as precipitous as compared to internationally. So since we were judicious in terms of reducing rates, I think the rate increase also is going to be moderate. Today, the kind of rates we have are pretty much the kind of rates that we had in pre-COVID times. So what we have seen is very much a normalization of rates. And therefore, to my mind, this increase in rates is not something that should disrupt demand in a significant manner.
We are speaking, at a time when we've seen an extraordinary unscheduled meeting of the MPC and the RBI, and not for a specific monetary policy action, but to answer lawmakers as to why inflation has behaved the way it has. And we'll wait for that reply as and when, if it were to be made public. But your own sense about what is the RBI going to do at the next meeting of the MPC, and what's your own overall reading of the inflation dynamic?
So I think, to my mind, in terms of inflation, things should start coming under control. We believe that the terminal repo rate should be in the region of, say, about 6.5%. And therefore, we don't have so much to run now in terms of, again, how much the rate could increase. So it is quite possible that going forward, the increases might be smaller as compared to what we have seen in the past. But I would again like to re-emphasize that what we are seeing is pretty much a normalization of rates, A. B, if we were to compare ourselves with the global situation, I think we should count ourselves very fortunate that we did not see any distortionary decrease in rates, and now we are not seeing any disruptive increase in rates.
Is a pause possible?
Yes, but possibly I would believe not in the next meeting, but somewhere down the line, there's a possibility. But to my mind, I would put my money on a little more increase in rates, but possibly again smaller in quantum as compared to what we have seen in the last few rate rises.
You mentioned in an earlier answer that it may perhaps not be correct to expect the same kind of loan growth rate. And let's say that this calendar year and perhaps the fourth quarter, there is a carryover of some demand. But at some point, would it not be fair to expect that the loan book will not grow at the same rate as it has in the past?
So I think, again, it is the context of what we are seeing. If we are to compare it with the previous few years, the loan growth is certainly going to be faster. If we compare it with what our prognosis was at the beginning of the year, it should be better. For instance, we were of the view that loan growth this year would be between 10 to 12%. Now, given what we have seen in the first half, I think it would be fair to revise that estimate to between 12 to 15%. But I think what we are seeing in the last few months, 16%, 17%, partly it is on account of the fact that there was a depressed base which was there last year on account of the second wave. So therefore, some moderation of that would be perfectly in order.
Okay. I have a couple of more questions for you, and which is the overall reading that you have of private investment. Now, this is a very significant part of the economy. The government is doing whatever it can within the circumstances and is also bearing the brunt, for example, of higher fiscal cushion on account of fuel prices, just as an example, or fertilizers. But we leave the macro apart. What's your own sense about private investment, and where does it stand for not just your bank, but overall from a India perspective?
So I think from the sense that we are getting is that private investment has been picking up over the last few quarters. It continues to pick up. It is also becoming more and more broad-based. What was confined to some particular industries is now much broader. Having said that, it is also true that in some ways the nature of it, the structure of industry has changed. There's been a fair bit of consolidation, and therefore the investment that we are seeing is coming from the stronger players who are increasing capacities. In some ways, it is also very good because it means that not only do you have loan demand, but the quality of loan demand is very good because these are the very corporates who had deleveraged significantly over the last cycle. So therefore, again, I think we should be fairly sanguine both about the trajectory that it is improving and also the quality of demand.
So, minus the uncertainties and this that have been induced by the age of inflation globally, as well as Ukraine and all the supply chain disruptions, if you were to try and take that out of the equation and go back to pre-COVID times, if I were to ask you about the sluggish private corporate story pre that, today as we look ahead into 2023 on its cusp, what kind of forecast would you have for, let's say, till 2024?
So I think the main difference between where we were in 2019 and where we are now is that capacity utilization, which was between, say, 65, 70% then, which is far lower a level as compared to where corporates would consider, again, fresh expansion. Now we are actually somewhere in the 75 to 80% range. So therefore, notwithstanding the factors that you pointed out, which are all told temporary, I believe the situation is much more conducive to a broad-based corporate investment cycle. Also, what we have seen is that in terms of margins, the corporates have done fairly well. So I think if we were to align the two factors, that the margins continue to be fairly good, and also that capacity utilization is now at that level where you might want to invest, I think at least from my perspective, the next few months, quarters should be much better as compared to what we have seen in the past.
A couple of quick questions, and this one has to do with the rupee in the headlines in the recent past. Will it continue to remain in the headlines?
So I think it all depends upon how we see that, right? So if you were to take any 5-year period, the average depreciation of the rupee has been about 3% which was perfectly normal given the inflation differentials that we had vis-a-vis developed economies. For the moment, I think yes, because of the fact that the dollar rates are going up, there's some pressure on the rupee. But if we were to take a medium to long-term perspective, and if we believe that the rate differential which has narrowed or become has reversed, if that is something that we are likely to see going ahead, given the fact that productivity in India is significantly high as compared to developed economies, probably again, we can be a little more sanguine in terms of the trajectory of the rupee in the medium term as compared to what we have seen over the last few years.
So what you are in a way saying is be patient when reading the headlines. My last question is on the NCLT and recovery rate, and I would request you right here that whenever you have the time, I want to do a separate detailed interview. But before we close, how for your bank is the NCLT experience in the latest quarter and an overall assessment as far as recovery rates are concerned? Is it going the way that you had expected, or has the recent sort of slowdown impacted your own plans as far as NCLT recovery is concerned?
So I think there are two ways to look at it. One is to look at the pre-NCLT situation with the current situation. I think the NCLT has been a big plus, not only in terms of resolution that we got through NCLT, but the fact that NCLT is there means that you actually can negotiate in terms of any kind of restructuring in a much more rational manner. So I think that is something which has been very salutary in terms of impact. Now, in terms of actual outcomes, we have seen about 25-30% average realization, although in some assets, particularly steel assets, the realizations were much better. Now, if you also juxtapose that against our NCLT book, where we are provided about 98%. So I think we are very well placed that whatever recoveries come our way, they'll be accretive in terms of the margins of the bank. We must, of course, bear in mind that the initial fast progress that we saw was because of the fact that those were cases which were the low-hanging fruit, the larger cases where the assets again were in good shape. I think as we go along, progress understandably is going to be slower, but the benefit that we have got from the mechanism that goes beyond the cases that are actually settled through NCLT.
And the main benefit you mean is better borrower discipline?
Absolutely, because at the end of the day, one is a situation where you have no other option. One is a situation where you have the option of the NCLT. That itself is, I think, a very salutary development.
Absolutely, Mr. Chadha. I would really request you to spare time for a more detailed discussion on that from a broader perspective as to how seminal this reform has been and perhaps if there are changes required. But we are out of time. Thank you very much for taking out the time. And with that, it's a wrap on this conversation with the Bank of Baroda. Thank you very much for watching.
If you like the video, do like, comment, share and subscribe.